Welcome in. We are tackling a debate today that sits at the very core of modern finance, something you have undoubtedly weighed if you manage your own portfolio.
Oh, absolutely.
And the fundamental question here is whether it is mathematically possible to consistently beat the stock market, or if, active trading is ultimately just a casino, like a fool's errand wrapped in the illusion of skill.
Right. It really is the dividing line in financial philosophy. You've got the efficient market purists who argue that alpha generation is basically a statistical mirage. And then on the other side, you have the reality of legendary value investors who've built generational wealth by seemingly doing the impossible.
Yeah. And to get to the bottom of this, we're looking at two vastly different sources on the desk today that approach this exact problem from totally opposite ends of the spectrum.
Very different. Yeah.
On one hand, we have a highly accessible, almost ground-level beginner's guide from the Young Investors Society titled Stock Investing 101.
And completely contrasting that, we have a dense piece of cutting-edge research. It's an econophysics paper published in 2022 by Xavier Brudy and Matthew Garson,
Right.
and that one is called A Statistical Test of Market Efficiency Based on Information Theory.
So a bit of a heavier read. But our mission for this deep dive is to bridge the gap between that common sense investing wisdom and the hardcore statistical mathematics of the academic paper. We are going to find out if the classic advice of legendary investors actually holds up to the rigorous scrutiny of Shannon entropy.
It's a huge test.
It is. Okay, let's unpack this. Because the Young Investors Society Guide, it starts by establishing a mechanical baseline for wealth creation. It strips away all the market psychology entirely and just focuses on the math of compounding.
Over really long time horizons, exactly. They use this great hypothetical scenario involving a 20-year-old fireman to really illustrate the nonlinear trajectory of building wealth.
Yeah, I love this example. So the premise is simple. He allocates a strict $1,000 a year to savings for 50 years, retiring at age 70. And the only variable is where he puts that money.
Right. Where does he park the capital?
So let's walk through the numbers.
Yeah.
If we look at a zero-yield environment, literally putting it under the mattress.
Or a zero-interest checking account.
Exactly. He puts in $1,000 a year for 50 years. He ends up with exactly $50,000.
Which, with inflation, is actually losing money.
Right. The purchasing power is severely degraded. So say he moves slightly up the risk curve to conservative real estate or government bonds yielding around 3%. That $50,000 compounds to roughly $116,000.
It's an improvement, sure, but it hardly secures a comfortable retirement. The structural shift really happens when that capital gets exposed to the stock market.
Huge shift. If we track the historical average return of the S&P 500, which is around 9.8%, that exact same $1,000 annual contribution balloons to over $1.3 million.
Just from the market average.
Just the average. And it gets crazier. If we assume this fireman possesses, an elite ability to pick stocks and earns an exceptional 20% return over that time, it would yield over $100 million.
Over 100 million. That exponential divergence it highlights the fundamental power of equity investing. The gap between a 3% yield and a 10% yield over half a century is the difference between just surviving and building real multi-generational wealth.
Yeah.
But the really critical variable acting on that return is the duration. How long is the money working?
The guide stresses this heavily. Starting early is everything. If our fireman starts at age 20, he gets the $1.3 million. But if he delays until age 40, the final portfolio value drops to roughly $190,000.
That's a massive penalty for waiting.
Massive. But conversely, if he shifts the start date just 5 years earlier, starting at age 15 instead of 20, that $1.3 million jumps to over $2.2 million.
It's no wonder Albert Einstein supposedly called compound interest the eighth wonder of the world. It reinforces the reality that capital deployed in those earliest years really dictates the terminal velocity of your wealth.
But securing those returns means dealing with the stock market, which brings us to volatility.
Which can be terrifying for beginners.
Oh, absolutely. Which is why the host, or rather the guide, leans so heavily on Benjamin Graham's famous analogy of Mr. Market.
Ah, yes, Mr. Market.
It reframes that scary volatility not as a risk, but as something you can exploit. Graham says to imagine you share a business with a partner who has wild mood swings.
He wakes up either totally euphoric or deeply depressed.
Right. And you have to explain why this matters, because how irrational are these swings, really?
They're incredibly irrational. The utility of the Mr. Market analogy is how it separates the underlying fundamental value of a business from its current stock price.
They use General Motors as the example, right?
Yeah, they highlight a single year where the quoted price of GM fluctuated so violently that the total market value of the company swung by $17 billion.
17 billion.
Right. And you have to ask yourself, did the actual business of GM, the factories, the cars being made, the supply chains, did that actually change by $17 billion in a few months?
Obviously not.
No, the underlying enterprise was static. The variable was just Mr. Market swinging from euphoria to depression. And that disconnect is the whole foundation of a margin of safety.
Waiting for Mr. Market to get depressed so you can basically buy a $10 bill for $5.
Exactly. You buy a steep discount to the intrinsic value.
And the guide distills this down into 7 golden rules. We won't list them all, but the big ones are thinking long-term, buying good companies, not following the herd, and diversifying smartly.
And they make a really interesting point on diversification.
They do. They note that 90% of the benefits of diversification come from holding just over 20 uncorrelated stocks.
Yeah.
You don't need to own 500 companies.
You're just buying the whole haystack at that point.
Right. And they also mentioned a rule of thumb for valuation using the price to earnings, or PE ratio. An average company trades around 15 times earnings. A great company, maybe 20 to 25 times. And a bad one is under 10. So you hunt for those low PE ratios to find your margin of safety.
But here's the thing. We have to recognize the massive assumption underpinning this whole value investing philosophy.
That's that.
Well, the margin of safety, Mr. Market, it all relies on the premise that markets actually misprice assets frequently and predictably. It assumes the market is crazy or inefficient.
Here's where it gets really interesting. Because while the Young Investor Society assumes the market is highly inefficient, the academic world has spent the last 50 years arguing the exact opposite.
The efficient market hypothesis.
Yes, the EMH. Can you break that down for us?
Sure. So Broody and Garson's paper focuses specifically on the weak form of market efficiency. Very simply, the weak form states that current asset prices already perfectly reflect all past price information.
So looking at past charts is useless.
Exactly. If the weak form EMH is true, statistical arbitrage making a reliable profit just based on past price trends should be mathematically impossible. The price movements are essentially a random walk.
And to prove or disprove this, academics usually use traditional math models, right? Things like the Hurst exponent or fractional Brownian motion.
They do, but Broody and Garson explicitly rejected those tools.
Why?
Because those models require you to assume that financial returns follow a standard bell curve, a Gaussian distribution, but we know markets don't do that. Markets have fat tails, extreme events.
Like black swans and sudden crashes?
Right. They happen way more often than a bell curve predicts, so measuring the market with those old models is like measuring with a broken ruler.
So they needed a new ruler. And instead of traditional econ math, they turned to information theory, specifically Shannon entropy.
It's a brilliant pivot. Claude Shannon created entropy to measure the amount of uncertainty or surprise in a stream of data. If something is perfectly predictable, its entropy is 0. If it's purely random, entropy is maxed out.
So how did they apply telecom math to the stock market? This is where Risso's method comes in. Let me translate the heavy math here into a simple analogy. Risso's method basically takes a sequence of daily stock prices and turns it into simple binary code.
Ones and zeros.
Right. If the price goes up today, it's a 1. If the price goes down, it's a 0. It strips away how much the price moved and just looks at the direction.
It turns the market into a digital signal.
And this becomes the ultimate litmus test for the EMH.
Exactly. Because if the market is perfectly efficient, it shouldn't have any exploitable memory. So regardless of the previous sequence of ones and zeros, the prefix, as they call it, the chance of tomorrow being a 1 or a 0 should be exactly 50-50.
Like flipping a fair coin.
Right. Even if you just had 5 down days in a row, 5 zeros, an efficient market says tomorrow still has exactly a 50% chance of being a 1.
So the researchers created a market information indicator. It compares the actual Shannon entropy of the real market against an ideal, perfectly efficient market. They were looking for a strict binary answer. Can you predict future price directions with a win ratio significantly higher than 50%?
They established very strict confidence intervals for this.
So what does this all mean? When they took this math and applied it to the real world, what did they find?
Well, they ran the test using real daily data from 2021, using a rolling window of 100 business days, and they tested four very different assets,
Let's walk through them. First up, the Russell 2000 Index.
which is a broad index of small cap companies. And the results here were totally unequivocal. Across the entire year, the test could never reject the EMH.
Never.
Never. The Russell 2000 was completely, perfectly efficient, indistinguishable from a random walk.
Okay, what about the second asset? Bitcoin against the US dollar. BTC-USD.
Now, this one is surprising.
Highly surprising. You'd think, given how wild crypto is, it would be incredibly inefficient.
Right, but the data showed the opposite. Bitcoin largely followed the EMH. It only showed inefficiency 4.2% of the time, meaning it was statistically efficient for nearly 96% of the year.
Wow. So extreme volatility does not equal predictability.
Exactly. Price discovery might be violent, but it's integrating new information instantly. The direction remains random.
Okay, third asset. The CANS 40 Index. This is the big French stock index.
And here the contrast is just stark. Astonishingly, the EMH was rejected 60.8% of the time.
60%. So for more than half the year, the French benchmark contained mathematically exploitable memory. It wasn't a 50-50 coin toss at all. Why would the CAM 40 be so inefficient when the Russell 2000 was perfect?
The researchers think it comes down to the number of companies. The Russell has 2,000 stocks. The noise cancels out. The CAM 40 only has 40 heavily weighted companies. So the localized mispricings of a few massive companies drag the whole index away from efficiency.
Which brings us to the final asset they tested. A single stock called Proficient, ticker PRFT. Now, Proficient is actually a stock inside the Russell 2000.
Right, keep that in mind. The parent index was perfectly efficient.
But when they ran the Shannon entropy test on just Proficient, it showed inefficiencies 57% of the time.
57%.
A single stock inside a perfectly efficient index was wildly predictable.
What's fascinating here is how this cutting-edge math perfectly validates the value investors' approach from our first source.
It proves Mr. Market is real.
It absolutely does. When you mix thousands of stocks together, the statistical arbitrage opportunities average out and disappear. The macro level is efficient. But if you look at individual stocks, the single donuts in the box, you absolutely can find market inefficiencies.
So if you're buying the whole index, you're playing a casino game where the house has perfectly balanced the odds. But if you zoom in on individual companies, those $10 bills selling for $5 are mathematically quantifiable. They exist.
It completely justifies doing the hard work to find a margin of safety. The forest is a random walk, but the individual trees are exploitable.
That is just incredible. To wrap this deep dive up, we started with the highly actionable, common sense advice of the Young Investors Society. Save early, let compounding do the heavy lifting, and wait for Mr. Market's mood swings to buy good companies at a discount.
A very practical approach.
And then we took that core assumption that the market makes mistakes, and we stress tested it against rigorous Ukana physics. And the math proved that yes, while broad markets smooth out into efficiency, individual stocks constantly exhibit exploitable inefficiencies.
But I do want to leave you with one final lingering idea directly from the limitations of this academic paper.
Oh, right, because Rizzo's method has a massive blind spot.
It does. The researchers summarized all price movements into just two states, a 1 for up and a 0 for down. In doing so, they admittedly lost a massive amount of information.
A 1-cent drop and a 20% market crash are both just recorded as a 0.
Exactly. They sacrificed magnitude to isolate direction. So invite yourself to ponder this. What if we expanded this Shannon entropy test to a continuum of states?
Measuring not just the direction, but the exact size of the price change.
Right. Just how inefficient and full of opportunity might the market actually appear if we captured every nuance of the data? If they found 57% inefficiency while ignoring the size of the swings, the true depth of the market's irrationality might be far more profound.
The opportunity for an active investor could be exponentially larger than even this test suggests. That is a brilliant thought to end on. Thank you so much for joining us on this deep dive. Keep asking questions, keep looking closely at the data in your own portfolio, and keep exploring. We will catch you next time.